what's the August update on that particular thing. We still see APRA throttling demand. We still see, the housing and rental crisis continuing, and the political risk associated with that in terms of the politics. We're seeing the Greens starting to win a lot more favour from those younger voters on the back of false promises and misinformation, but ultimately it still wins votes. In terms of higher interest rates for longer, that's going to also potentially put downside risk on demand. That's on the back of those higher inflation with the government, fiscal stimuluses. We do have a slightly elevated risk of recession. We talked about definitely higher unemployment. So that idea of a softer landing becomes more potentially of maybe a harder landing that we've just got to try and navigate through. Housing affordability prices are still going up, so that continues to be a thing.
Ben, on unemployment, it's one of those interesting ones, isn't it? Because for the person who gets unemployed, it's a downside risk, but for the market in general, it's actually a positive sign that inflation, because that's one of the markers for inflation, right? So It's kind of like, it's great if you're not unemployed, but if you're the person who gets unemployed, it's not good for you. So it's kind of one of those double-edged swords.
Yeah, it's the blunt instrument that is monetary policy that manufactures a slowdown in the economy, which forces unemployment.
Mm-hmm.
And remembering inflation is driven by variables such as input costs, but also productivity of workers. And so in some cases, if the business makes a decision in terms of whether they want to maintain their profitability or basically pass their costs on to consumers to maintain that profitability, or the consumer then doesn't spend, and then ultimately the business is forced to look at their cost base, and a lot of that is obviously wages. So that's when they start laying people off as part of that story if they can't find other savings in the supply chain. So that's effectively what's happening in a slowing economy that we're seeing here as well. We've seen some increases in some forced closures or mortgagee possession sales, but again, such a small number. It's really, I commend those people who have mortgages at the moment. They're doing a great job of staying viable. There has been, an increase in defaults, but it's coming off very, very low basis. So there's no real systemic risk there, but it still remains a risk. Student visa program we just talked about in the short term, those that rental demand will dry up a little bit in some of those isolated pockets that we were talking about. Now, in terms of the upside story, and this is the good news story here, is we've talked about it before, chronic undersupply of housing. That's going to continue to be the case. The government mixed policies around going after that planning regulation we talked about, but ultimately also potentially doing stupid things about regulating markets and not letting them to regulate themselves. And that obviously then deters people from taking action because they can't trust the government. So they don't want to spend their tens of billions of dollars on investing if they can't trust governments. Then you've got obviously the general folks who are just getting on with things. So we've seen that in terms of the actual overall activity of sales. We saw that earlier. And that is a classic case. Remember, investors should only really be 30% of the market, 35% maybe in those sort of headier times. But ultimately, we should be price takers, not price makers. So if we're the ones who are making the prices, then ultimately is that a sustainable revaluation of that asset over time? So that's the weighing machine versus the voting machine story in terms of if too many investors go into some of those affordable markets and it's just an investment story like we do when we go into regional towns and those types of things, that's where the risk lives in terms of some of those mining towns as well. So we don't want to get ahead of ourselves from an investment point of view. We want to be sensible about the long-term prospects and the fundamentals economically and also viability of those, big engine rooms and those economies wherever we're buying, whether that's regional or also in the big city areas. Inflation will remain higher, so that's going to be slower to come down, which means interest rates are going to be slower. But once they do come down, boom, we will see a sentiment shift as part of that. We talked about those real wages continuing to grow off the back of that as well. So that's the precursor in terms of where we're sitting ourselves from a buy demand point of view. So we'll take a bit of a look in terms of what that story looks like. And I'll just switch over to our research platform again. And we can see here, when we go and have a look at our demand supply DSR ratio, we can start to see in terms of what's happening across all of those towns and cities. So when we start to look at, some of the bigger cities, so we'll start with the Melbourne and Sydney story, we can see that, interestingly enough, and this is what we're sort of saying about why Melbourne's probably been more resilient than we've expected it to be, is because there's still underlying demand there, that's ultimately looking to meet that supply that's in play. And so that's been a really positive for them. You can see also Perth's story over that longer term, why we've seen such incredible 24% or whatever it was growth that we saw in those numbers we spoke about earlier. That's really come along, and so that's still very much a strong market. Then we've got Hobart. Well, again, that's why we were concerned about that particular market in terms of its price correction. So that price correction will continue over time. We've got Darwin also sitting down there in terms of not a lot of confidence and sentiment. So that's not necessarily showing any signs at the moment. People will, again, eventually stumble on that and have a look at that as a market for cash flow in the future. When we start to think about Canberra, we can see here that it's also got a reasonable level of demand and supply, and we think that's coming into a new up cycle for that particular market, but that's owner-occupied led. That shouldn't be investor-led. In terms of Brisbane, we can also see still a really strong reading in that sort of around that 60% mark is always pretty healthy. And then we've got Adelaide with the strongest reading of all at 62. So continuing to find a way to keep moving that value in terms of that overall story. So
it's
that's
worth reminding context there too that the demand supply ratio is a secret herbs and spices algorithm.
Yes, 17 variables that make up the score out of 100.
That we created in terms of where demand exceeds supply, right? So that's in the short term, right? Which needs to be sort of put in context of fundamental analysis about what makes property go up in the long term, but it also gives you a best chance of being in front of the wave, right? So therefore, anything that's sort of above 60 would be considered very healthy. Anything that sort of starts to get below that, you start to see where supply exceeds demand. Therefore, you're not in the same position of power to see that sort of immediate growth.
Yeah, well said, Bryce. You couldn't put it better myself. So in terms of then looking at the days on market, which is the other important measure that we want to be looking at, we can start to see the different types of markets that we've got going on here. So let's unpack that story in terms of what it looks like. So we can see here, looking, let's start with our biggest capital city again. So we've got, the average days on market is 38 at the moment. Now that's down from around 42 that we saw at the start of the year. If we look at Perth as the secondary market we looked at here, so the days on market is now down to 29 days. At the start of the year, we were sort of looking at 35. So the trend line is very strong for those particular markets. In Melbourne, we've seen the days on market sort of sitting at around 42 in January, and that's now still sitting at 42. So again, no sort of indication of upwards or downwards there. You can see here in terms of Hobart sitting at 46, that's now moved to 49. So the trend is going in the wrong direction there for price pressure. Then you look at Darwin. At the start of the year, we saw that market sitting at 94 days. It then peaked at 100 days, but it's now back down to 94 days. So that's starting to trend in the right direction. Then we've got Canberra. We can see here again, 49 days. That's pushed out to 51 days at the moment. And then Brisbane, again, very, very strong market, even though it's had a really lovely run for several years now. You can see days on market 37 in January. It's now down to 31. And let's have a look at Adelaide. We can see also 42, and that's just come down to that 41 level. And that's why it's always important to remember when you're looking at one piece of data in isolation, you should never make a judgment just on one piece of data. It's about bringing all of that story together. And that's obviously what the demand supply score does, right? In terms of sort of putting all of that data together. That's why we use it as one of our core metrics. And we get that down effectively to the suburb level, not just looking at the macro level, because there's always markets within markets in terms of how we analyse the property market.